Subscribe to Learncab and hit the bell icon to get notified.
Yes guys, so have a look at question number 1. ABC Limited granted to its employees share options with a fair value of 5 lakhs on 1st April 2010 if they remain in the organization up to 31st March 2030. On 31st March 2011, ABC Limited expected only 91% of the employees to remain in employment. On 31st March 2012, the company expected 89% of employees to remain in employment. However, only 82% of the employees remained in the organization at the end of 2013. All of them have exercised the options. Past journal entries in this regard. Now, carefully look at the question. What is he talking about? First of all, I need to identify the grant date. Look at the question and keep placing the numbers. Question number 1. I'll first start with the grant date. What is the date of grant? The grant date here in this question is 1st April 2010. 1/4/2010. Now, apart from that, look at it. He's saying that if they remain in the organization up to 31st March 2013, so that means my vesting period is 3 years. What is the fair value of option? Fair value of options. The options have a fair value of, look at the question. They granted to employee share value with a fair value of 5 lakhs. Vesting condition is continuous employment. Vesting period is for 3 years. At the end of 3 years, 5 lakh is the fair value of the options which are expected to vest. But now, if I have to recognize a provision regarding the share-based payments, then I will be doing it at the end of each year. What is the end of each year for you? Now, you look at this. This is a template for which I'll be solving the question. This template is common for all the questions. Please be very careful when you get the template right. Now, there are 3 balance sheet dates on which expenditure has to be recognized. 1st April 2011, 1st April 12, 1st April 30. These are my 3 years for which I'll have to recognize the provision. So I will maintain those 3 columns first. 31st March 2011, 31st March 12, 31st March 30. Right? Now, for these 3 years, I'll have to recognize a provision regarding your share-based payments. How do I recognize a provision? Now you read through the question. On 31st March 2011, ABC Limited expects only 91% of the employees will remain in employment. On 31st March 2012, they expect only 89% to remain in employment. However, only 82% have completed the 3 years of vesting, have remained in the organization at the end of 31st March 2013. So he has given me number of employees, not number guys, percentage in this case. Normally they would give numbers, but here it has been percentage. Number of employees who are expected to satisfy vesting. How many employees or what percentage of employees will remain in the organization to complete the vesting condition of 3 years. At the end of first year, enterprise expects only 91% to remain in employment. By the end of second year, my estimate became 82. Third year actuals is 89 and 82. I expected 89. actual people remaining at the end of 3 years is only 82. You know what is the fair value of option? Just write down. Fair value of options which are granted, 5 lakhs throughout, no doubt about that. Now, out of this 5 lakhs, only a certain percentage of employees are expected to satisfy the vesting. Therefore, total employee benefit expense. This is the total expenditure that I have to recognize. How much is the total employee benefit expense that I have to recognize? Look at it carefully. 91% of 5 lakhs, 45,000 minus is nothing but 4,55,000. 45, 44, 4,45,000. Last one, 4,10,000. This is the expenditure that is expected to be provided by the enterprise. Will you provide it entirely in the same year? No, because I know that this expenditure is not due at the end of year 1. It is only due at the end of year 3. So why should I provide the entire 4,55,000 right away? So I will have to provide this expenditure over the entire vesting period on a straight line basis. Vesting period. 3 years, 3 years, and 3 years. Based on this, I'll have to calculate now. Let's go. Expenditure. Under that first one, cumulative expenditure. Reduce the expenditure which was already provided in the previous year minus already provided. The balance should be to be provided in the current year. Be provided in current year. Look at this. First, the cumulative expenditure. You know the total expenditure should be spread on a straight line basis over the vesting period. So at the end of first year, I'll be looking at 4,55,000 into 1 by 3. First year ending, only 1/3 of the provision. By the end of second year, 4,45,000 into 2 by 3. 2 years out of the total 3 years are completed. So much amount of accumulated provision is necessary. Third year, let's not write anything because anyways it is 3 by 3. It will straight give you the same answer of 4,10,000 again. So 1 by 3, let's multiply and check. Divided by 3, 1,51,667. 455 divided by 3, yeah, 151,667. 445 divided by 3, 2. This is 2,96,667. How much is already provided in the previous year? For the first year, that is the first time that you're creating the reserve. Therefore, there was nothing provided in the previous year. Entire 1,51,667 should be provided in the current year. If 1,51,667 was already provided in the previous year and the total provision should be 2,96,000, then in the current year only 1,45,000 of provision should be created. If 2,96,667 were created in the first 2 years, The last year, the amount eligible to be created is only 1,13,333. And that will bring us to the end of expenditures to be created or to be provided each year for these kind of employee options. If I have to pass an entry for this, let's look at it. Okay, he asked me to pass journal entry, so I will pass it. I'll put the heading as journal entry in the books of the company. The first journal entry that I'm going to record would go something like this. Employee benefit expense, account debit to share-based payment guys. Payment liability or payment equity will depend on the type of options. Look at the options here. They are share options. So employee share based equity. I'll call it as a liability if they were stock option or stock appreciation rights. This entry, the first one, will have to be passed on 31st March 2011. 31st March 2011. Entry to be passed for amount how much? Amount up above 151,667. 151,667. At the end of the year, this employee benefit expense has to be transferred to P&L. This is a perfect nominal account. So transfer it to P&L. P&L account debit to employee benefit expense. Guys, these two entries will be repeated for 3 years with the changing amounts. Amounts keep on changing because on 31st March 2012, I'll have to pass the entry for 1,45,000. 31st March 2013, I'll pass the entry for 1,13,333. First year transfer to P&L is still the same. 1,51,667. 1,51,667. Second year, the entry will be 1,45,000. Now it is the same entry getting repeated. But towards the end of the year, these stock options are getting vested. Therefore, they were exercised. Look at the last point. All of them have exercised the option. Since all of the employees have exercised the option, after repeat the entry for 3 years, on 31st March 2013, I'll have to pass the exercise entry. Entry for exercise of options. What is the entry for exercise of options? Share-based payment equity. Share-based payment equity account debit. What do you issue to them? To equity share capital. So I am reducing the equity part and I am transferring it to the equity share capital. How much amount? Not the entire 5 lakhs. Look at the amount of reserve that you have created towards the end of third year. The total cumulative reserve which I have created here is only 4,10,000, not the entire 5 lakhs. To that extent, equity shares will be allotted to the employees when the shares will vest. That will be the last entry to be recorded. Here there is no lapse. The question very clearly told me that all the employees have exercised the option. So therefore the entire amount of share-based payment equity is transferred to share capital. Guys, sometimes there will be a lapse in the following questions. In such case, we will have to divide the share-based payment equity into the employees who have exercised the option and the employees who have lapsed the option. To the extent of lapse, they should be transferred to a general reserve or any other free reserves.
Subscribe to Learncab and hit the bell icon to get notified.